2 minutes gone, so we'll get going and people can still join the room.
Perfect. Yeah, go ahead
Perfect,
there,
yeah.
Claire. That's great.
Great. So if we just move on to the first slide, everybody's very welcome this evening to Irish Pensions and Finance Investment Webinar. So just to explain quickly who we are, and then I'll talk about who the presenters are this evening. Irish Pensions and Finance, we are a wholly owned Irish brokerage. We're up and running since 1993. Our main source of business would be the group AVC scheme through payrolls in the public sector. But we are, a full brokerage and we offer all financial services. So tonight's focus is going to be on investing your money, if it's a good idea or not, okay? We have a team of financial advisors. We've nearly 120 staff. We've over 30,000 customers who trust us with over 1 billion in funds under management. I think we would obviously say that we're very proud of what we do, but I think if you want to kind of get an objective view of that, we are really proud of our Trustpilot rating of 4.8, so you can check us out there. So that's who Irish Pensions and Finance is. My name is Claire Hanrahan. I am the Managing Director. I'm also delighted to welcome Neil White. He is a certified financial planner and he is one of the regional managers here at Irish Pensions and Finance. And then we'd love to thank as well James Forbes for joining again. James, this is our 6th year doing this webinar. And James is the head of investment solutions for Goodbody Asset Management. So just to explain in the ecosystem, who's Irish Pensions and Finance and who is Goodbody. So we are the brokers, so we are your financial planner. And you and Neil White will talk to us in a few minutes about the kind of process that we go through. But if you sit down with us and we come up with a solution that you want to invest some money, we can help you invest your money with an investment manager like Goodbody. Okay, so what is the plan for the evening? Just a few house rules. Okay, so what I'd say we think we'll run about an hour. All right. What we are going to do is we're going to keep the chat function just locked while we're going through the content. But we have received questions in advance from, the attendees that have registered. So what we'll do is at the end, James and Neil have kindly agreed to do some of the questions. So we'll handle what we can. But if we don't get to people's questions, our advisors will be in touch with you over the next couple of days. And they can go through your questions, okay? As well as that, what we always do is we always have a prize of €100, one for all voucher. So pay attention to what you see on the slides, because at the end we will ask a question and fastest finger first will win the €100 one for all voucher with the right answer. And also to say thanks very much to Sarah Connolly, who this wouldn't be possible without you, Sarah. So you're there in the background getting it all organised.
Thanks, Claire.
And look, I think now, like this year more than ever, I think we've had more interest about this seminar, just with everything that's going on in the world. I mean, we were even like dying to hear what James is going to tell us this evening. So,
Yeah.
but just before I bring James in, Neil, can you tell the kind of the people here this evening what takeaways we'd love for them to get from the webinar, please?
Yeah, Claire, like I think there's three key takeaways really that we want you coming away from today. And look, they really are what are the pros. And then obviously if there's pros, there's going to be cons around investing. So getting a better understanding of what that means and what they are. Then a really topical thing, what's the impact or what impact could inflation have on your geopolitical situations? Like how do they drive inflation? And how does that impact on money maybe that you have in savings and what you should be thinking about? And you see so much in the news, but at the end of the day, what does that mean when it comes to you and your money? And then I suppose where potentially myself and IPF come in into the question then is what options are available to safeguard your money on deposit? Like what can you do or how can you get your money to work hard when, there's a lot of factors out there that are actually, impacting on it, like inflation and things like that. So look, they're the three key takeaways. There's going to be
Yeah.
other things you're going to take away from it, but that's what we'd like you to come away from tonight with, I think really is the long and the short of
Yeah.
it.
So then I suppose we're talking about why people should invest, Neil. So what's your experience of this? Because
Yeah, so look,
you can't just leave the money under the mattress.
no, unfortunately not. No,
You
and
can't? Okay.
you can't. You can't. No. So I suppose, look, it's a really good question, and we would find that there's kind of four key drivers as to why people look at investing their money, and one of the main primary ones is around deposit rates. So if you take a look at what you get from your money sitting on deposit these days, compared to maybe a good few years ago, where I think we can all remember times you used to get 4 or 5% for your money sitting on deposit. Like
Yeah.
I can remember when I had money in the post office and my communion money was there, £100, and I'd walk
Is
out.
it still there, Neil?
That's contrary to popular belief. It's not still there. But that has changed, okay? And as a result of that, you're more likely to be looking at maybe a 0.5% or a percent best case scenario. And you might say to yourself, well, look, I'll just have to take it on the chin and it is what it is. But the problem with that is, and I think over the last number of years, is you may have been able to take it on the chin because we've been in a period of low deposit rates, but also low inflation. So you've actually been okay to say, look, I'll grin and bear it and I don't need to worry about it. But unfortunately, inflation, which is kind of number two in that, it has come into play over the last number of years, and it's really topical. And I know James is going to really kind of get into that in a bit more detail on what the drivers are. But in effect, inflation is like a silent thief. It's going to be there impacting on your money, even though on the face of it, it looks like it's not going down. But in the real power, because what inflation is the cost of goods or services increasing over time. And we're in a period now where that seems to be coming back again after we kind of settle down a little bit. And then that's going to have a knock-on effect into the cost of living increases. So your day-to-day bills, your electricity, if you want to get work done in the house, the cost of your children's education in the future, that all is creeping up over time. And what that means then is people are saying, well, if all those things are going up, but my money isn't getting a return, am I being foolhardy and do I need to look at options outside of that? So they're the kind of three reasons why people come to us. And then another one would be that they want to get their money to work hard for them. So I know, Claire, you mentioned we have a predominant amount of our clients would be public sector employees and maybe have come to retirement and worked long and hard to receive a retirement lump sum. And they feel, look, it's there now. I don't want it not to be working hard for me after I worked so hard to build it up. Because again, they might need it straight away for goals or objectives that they have. So, they need to make sure that it's keeping in line with inflation.
Yeah, and I
And I
think
think,
actually it's funny, just before we jumped on the call here, we were talking about like longevity in retirement, and people are
yeah,
living longer. So they're going
big
to
time.
have the money there to help, fund their longer lives.
Exactly. And that's something I'll touch on, and it's something that's so important. And it's great to see because I sit down with clients and, they may have plans of going back to education, they might have plans of travel. So they've loads of great things that they want to do. And I suppose our job as financial advisors is to point out the pitfalls of leaving your money in certain places, but the benefits of maybe looking at investing it as well. I think that's why it's so important to talk to an advisor, on those kind of things, on those topics, I should say.
Very good. Okay. So, just from the outset, and before we get into kind of the stuff from Goodbody, like what is a consultation process? So, what can somebody expect to happen if they decide they want to sit down with an advisor, Neil?
Yeah, so I suppose what will happen following on from today is that we'll be in touch with everybody for what we will call the screening call or the 5-minute call. And look, it's so important, and I can't encourage people enough to avail of that because I'm yet to kind of speak to anyone or talk to anyone that doesn't come away from that call with something, either that they have a bit of peace of mind to think, okay, I've answered a couple of questions that I have. I don't think it's for me. It's
Yeah.
the right time to sit down for the full financial plan and review, but maybe next year. Or they say, look, there's an opportunity and I'm going to follow through and take advantage of I suppose we would have the complimentary financial plan and reviews and take a look at my options and see maybe do I need to explore savings or investments. And if we do decide, look, it does make sense to sit down, what happens is we'll book you in typically on a Teams or a Zoom call because we find that works best. We can screen share and kind of go through things in detail. If
Yeah.
we're meeting with a couple, it's great to have both together on the call. It's really, really important. And what we'll ask you to do and what we'll have done ahead of the call is identify what your goals are. Try and understand, well, look, what is your medium to long-term objectives? And then from that, we'll be able to identify and going through the fact find as well to get a full understanding of your circumstances. So if we do make a recommendation, it's based on all the facts. We'll take an assessment of your attitude towards risk. So what's your appetite for risk? What's your attitude to savings and investments? And then from that, we'll put that all together and make a recommendation that's suitable for you and based on what you want to see happen. And then obviously, as we go through that process, then we'll complete the application. We'll walk you through that and a bit of hand holding to get that done. But then the next part, so what I arguably would say is the most important thing is the regular reviews, checking back in.
Yeah.
If you're unsure of anything or anything like that, the regular reviews are so important. And it oftentimes reinstates the hard work that you've done, even though you might have seen a lot of topsy-turvy things happening in the markets.
Hmm.
And you look at your investment, it's still been doing quite well because you've stuck to the plan, you've put it in place, you've listened to your advisor. I think you cannot
Yeah,
emphasize enough the importance of the annual reviews and engaging in
very
them. I
good.
think they're so important.
Great. That's really good.
So the QR code there, just as a kind of a cheat code, we will be in touch with everybody. But if you do feel as you're going through this that you think, actually, do you know what, that's something I'd really like to talk to an advisor. If you fill that in, that's actually going to, generate a callback request, and we can get somebody
We
to
can
make
get them
contact
kind of
with you.
bumped up to the top of the
Yeah,
queue kind of
they
thing.
bumped up to the top of the queue. Exactly. Yeah, yeah,
Great.
for sure.
Okay, great. So, James, we're here again, 6th year.
Exactly.
And every year we come back and we go, oh my, we look back at last year and we go, wow.
Yeah, couldn't be any madder.
Yeah, it couldn't be any crazier.
Well, I suppose a lot of us to do with a certain individual on the far side of the pond that certainly makes the headlines and certainly drives markets as well.
Okay, great.
So I suppose for the next 25, 30 minutes or so, really just maybe talk through a little bit about what's been happening and maybe about the current situation, and certainly the events over the last 3.5 weeks certainly makes things
Mhm.
very interesting, particularly for investors. So I might
And I
just
think, James, what, like, say, from the people on the call this evening, what I think is great to be able to do this because you normally just speak to brokers. Okay, so customers wouldn't normally have access to what you would be talking to them about this evening. But there's so much noise out there. Social media platforms, the news, it's coming at you all the time. So I think this is a good opportunity for people just to get the facts, whatever they are.
Yes, Claire, I think that's really, really important because, generally where we get a lot of our news is from the news outlets. And, when we switch on the radio or pick up a newspaper or dial into our phones, it's bad news sells, that's
Yeah,
what grabs the headlines. So often when you hear, about things about equity markets, for instance, you'll hear, equity markets fell 1.2% today, but you'll never get a headline from RTE saying equity markets went up 1.2% today. That's
yeah,
good news. That doesn't sell. So certainly we certainly are biased more towards the bad news. And the challenge that we have as advisors is often when a lot of clients see bad news, they sometimes take decisions which maybe are not the best decisions to be taken at that particular time. And that really comes back, I think, to Neil's point earlier on in terms when you do the fact find, your attitude to risk, you've got a plan then. So once you've got a plan, and you can adjust your plan over time, of course, with your financial advisor. But once you've got that plan and you can stick to that plan, that makes traversing through markets like what we have today a lot easier. That you've got
for
your
sure.
plan, what you're expecting of it. There certainly will be volatility in the world. It's the world that we live in. But the important thing is to try and protect your wealth, the wealth that you've worked very hard to build up.
Absolutely.
So I'll try and move this slide on and see if it'll work here for me. Maybe I might ask Sarah if I have the access to it. There we go. This is a really, really important slide. Sorry, the previous one is my get out of jail card.
Oh,
So
very good.
it's
I
my
need that there.
compliance. And I do have to stress if I say anything here this evening, it is not a recommendation. The advice, you talk to people like Neil and they'll give you the advice. So I'm just updating a little bit on what's happening with regards to markets. But maybe before we start in markets, what I might do is maybe just look back on last year. I'm going to try and move this slide on here. Maybe Sarah, can you take control of the slides? Yeah, there. So this is the first part. This is just a chart here which shows the MSCI World Index. So this is the Equity World Index for 2025. And what you can see in this chart is that the Equity World Index at the beginning of February last year was doing quite well. It was up about 5%.
Mhm.
And
Okay.
then you might remember President Trump sitting in the Rose Garden with his whiteboard and Liberation Day and announcing all the tariffs. And that caused a lot of uncertainty in the world. A lot of companies didn't know what it would mean for them. What would they be paying for goods? What would their customers be? What would the demand be like? So there was a lot of uncertainty. So equity
Absolutely.
markets sold off, and we actually had a 20% decline in world equities last April. But I suppose from the chart on the left-hand side, what you can see is that over a period of 4 or 5 weeks, the market actually recovered quite a bit again and started to settle down, absorb the information and think about where the growth was going to come from. So at the end of the year last year, if you were invested purely in the World Equity Index, that's 1,300 companies, you generally would have got a return of around about 7%. But the key thing last year, what investors were seeing is that it was just 25 stocks drove most of the return in equity markets. So if you think of the largest stocks in the world, the Nvidias of this world, the Amazons, the Microsofts, they're the largest stocks. 25 stocks drove most of the return. The other 1,275 odd didn't do very much at all. And I
Yeah.
don't think it'd be any surprise to anyone on this call this evening what was driving those stocks. What sort of stocks were they? Most of those stocks were involved in AI and what the AI applications would do. So they were a key driver. Banks did quite well last year, and unfortunately, defense was also one of the areas that did particularly well. So yeah, this situation. So AI, banks, and aerospace. But of course, some sectors of the markets did particularly well. Other sectors struggled a little bit. And on the next slide, we just show some of the headwinds in 2025. And the first area where there was a bit of a headwind was in the software sector. What is happening in software is that the investors were looking at what would AI mean for a lot of these software companies. Would new AI tools come along? Would competition come along? Would they disrupt? Would companies' business models change? And investors are really struggling to work out what will it mean. And when investors struggle to work out what will the change in the business model mean, generally what happens is share prices come under a bit of pressure. So software was an area last year that came under quite a bit of pressure. I think the other bit that people might be a little bit surprised about that also came under pressure was the industrials, because in the industrial sector, we had expected that there might be a pickup in the industrials because Trump this time last year, if we were picking up the newspapers, was talking about bringing a lot of businesses back into the
Yeah.
US. He
Oh,
was
yeah.
talking about reshoring was his word. And we were looking at that and we were thinking, well, if he's bringing lots of pharmaceutical businesses back and engineering businesses back, they're going to have to build the industrial sector, the manufacturing sector, and this should be good for industrial companies. But unfortunately, when he started with the tariffs, that caused once again a lot of uncertainty. So this whole sector struggled again in 2025. And then finally, one of the other key thematics that President Trump talked about in his electioneering was that he would lower drug prices. So he was determined that he was going to talk to the major drug companies and say to them, we're not paying this for the drugs. You've got to lower your prices. So there was a lot of uncertainty over the pricing of drugs and what would that mean for profits for these companies. So many of the pharma companies, they suffered quite a bit in 2025 as well. So that's really what happened in 2025. Generally a reasonable year is the way I would call it, up 7% or so. Very narrow in terms, you had to be in the right sectors, but certainly some challenges with regard to some of the other sectors that were under quite a bit of pressure. I would actually even argue some sectors were in recession, the likes of industrials and US housing, for instance. But that was last year, and I suppose one of the things we often do at the beginning of the year is we look at some of the things that investors worry about. And on this next slide, what you see here is some of the evidence from a survey. So this is a survey carried out by Bank of America Merrill Lynch, and they do this survey of fund managers all over the world. So fund managers that are based in America, fund managers in London, throughout Europe and the Middle East and in Asia. And every month they ask them a series of questions. And at the very end of December, they asked these fund managers that control trillions and trillions of dollars of assets, what were you worried about in 2026? And in that survey, the biggest worry that most fund managers had was that these AI companies were in a bubble. They were worried about the valuations. They were worried about the amount of spending that was going on. The
Mhm.
second thing they really worried about was disorder within the fixed income or bond market. So a bit worried about that. Inflation was way down at 17%. And even though we had the trade wars last year, fund managers at the beginning of this year weren't at all worried. Now, we used this slide actually with some clients in February. And one of the things that we said about this is that, probably the thing that could derail markets or often derails is not the things that we talk about, it's the things that we don't talk about. And if you move on to the next part of this slide, one of the key things was not just the AI bubble, but what implications would AI have on some of the other parts of the economy? How would it impact things? So in February, AI was still a factor, but it wasn't valuations. It was what would it mean for me? How were my companies going to be changing? Could it mean that there'd be less jobs? Could it mean that there'd be greater competition or lower prices? So that's where AI came from. But as we said earlier on, it's often not the things that we talk about that is the worry, it's the things that we don't talk about. And on the next slide, I suppose what we see here is one of the other risks, and it's the US administration. And certainly
Yeah.
they operate very differently to previous administrations. There's no doubt about it. I suppose when you see Operation Epic Fury, it almost seems like a group of young people got together and created a video game and trying to work out what do we call it? Oh, Epic Fury. If it
Yeah, for
wasn't
sure.
so silly, but it's so serious because of the implications. But this operation was kicked off at very short notice. There was very little preparation done with regards to the electorate. There was very little information provided to so-called allies of the US. And it caused a lot of problems in terms of markets because people couldn't work out what were the objectives. And in the middle there, this is just a screenshot from the Financial Times. And the messages coming out were not clear. What was America going to try to do? Was it trying to topple the regime? Was it trying to get access to the nuclear potential weapons that Iran had? Would they actually put troops on the ground? And of course, what we've seen was oil prices rising very, very significantly. And certainly that's something that's, the headlines as we sit here today, every time we switch on the radio, pick up the newspapers, we're often hearing about the oil prices. And I think even this evening, the government's out talking about what they're going to try to do to mitigate some of those
Yeah.
factors. But I suppose on the next slide, we as a business have been around for 10 years and we started in March 2016. And this is a chart here which just shows the performance of one of our funds over those 10 years. The fund is actually up over 100% in the 10 years. It's the Goodbody Dividend Income 4 fund. But more importantly than the fund and how it actually done, is some of the events that we've experienced along the way. And when we got going in March, a couple of months after that, we had the unexpected Brexit announcement. And at the time, we thought that was big news, but you can hardly see the blip about Brexit. COVID-19, that was a major event that happens typically once every 100 years. The global economy virtually stopped. We were locked up in our houses effectively for the best part of 15 months. But even when you look at the blip on the chart there for COVID-19, it doesn't seem too bad. And then more recently, of course, we had a situation whereby we actually had a war in Europe again when Russia invaded Ukraine. And certainly that had an impact on equity markets as well. But I think, what this slide shows is that we're always going to have something. There's always going to be a headline. There's going to be something to worry about. And, I often think back and I read quite a bit from a guy who writes a lot about the psychology of investing. And on the next slide, Joe Wiggins says, and I think it's a great quote, it's incredibly unlikely that we're going to make good long-term decisions during times of acute worry. And I think that's really, really true. You're always going to have a situation. The knee-jerk reactions are not probably the best things to be doing when it comes to investing. And certainly that's very true today. And if you look at the next chart, what you can see here is Brent crude oil, and Brent crude has gone from 80 to over 100, currently in around about 100. And that's what we've been hearing from the news stories over the last 3.5 weeks or so. But this isn't the last 3.5 weeks. This is actually from February 2022 when Ukraine. So if we're sort of looking for a playbook and thinking about things like what could happen to investments over the next number of years, I think we probably have a bit of a playbook if we look back at what happened in early 2022. So, of course, the Russian invasion happened towards the end of February in 2022, and oil prices, they rose very sharply. But if we look at the next chart here, this is the oil price, the Brent crude price, and it goes all the way from 2022. So we see that it rose sharply when the invasion first happened. It went up close to $130. Then it started to come back. And over the following 4 years or so, it drifted downwards, down towards $60 until the last 6 weeks or so, when obviously events in the Middle East caused another sharp price increase. But if we look at this playbook, and maybe if you just flick on to the next part of this slide, what you can see is that the oil price back in 2022 during the Ukraine invasion, it actually went up 62%. So although it went up slightly higher to close to $130, its starting point was higher. So the percentage was 62%. If you look at the increase in the last 6 weeks, we're up about 86%. So we've got a bigger increase in terms of the oil price in the last 6 weeks than what we had over in Ukraine. And I think that in itself, certainly for people that may be closer to retirement or in retirement, poses one of the biggest risks, because the risk that we potentially have today is that inflation starts to pick up again. And if inflation picks up, if you've got money in deposit, generally, it's going to eat into that money. And that's something that's very, very real. And in fact, my mother, I'm going up to meet her on Friday. My dad died about 2 years ago, and then after the first year, we told her not to do anything with any money, etc. Just keep it pretty much on deposit, keep it there. It's a good place to have it. But on Friday, I'm going up to have a conversation with her about maybe investing some of that money, because what we're going to likely see with the increase in oil prices, transportation prices are going to go up, heating oil is going to go up, our energy bills are going to go up, food prices, because fertilizer prices are going to go up. We're going to start to see a gradual increase again in inflation. Now, unfortunately, I don't have a crystal ball, and I can't tell you when potentially this war is going to end. But even if it were to end this evening, the oil price isn't going to go back down to 60. It's going to stay elevated somewhat for quite a period of time because of the disruption caused. So I do think keeping an eye on inflation is one of the biggest risks potentially that many investors are going to face over the coming 24 months to 36 months at least. So that's just something
inflation
to bear in
had
mind.
calmed down, yeah? It had kind of...
Yes, in this chart, I've just looked here. Now, this is Irish official inflation. So this is from the Central Statistics Office. I would say it probably undershoots what we actually pay. Certainly in my household, I seem to be paying an awful lot more when groceries come into the house, or we're paying for ESB bills, or paying for TV, etc. But the official inflation rate in 2022 in Ireland rose close to 8%. Inflation then rose by about 6.25% in 2023. It fell down to 2% in 2024, and it rose again to about 2.5% in 2025. Now, in theory, many people would look at this and say, well, that's not too bad. It's fallen back down again. But if you look at that 4-year period and you look at the cumulative effect, it's very, very significant. And on the next slide, what I'm showing here, Claire, is that if you had a basket of goods, that you went out and you bought a basket of goods that cost €1,000 in 2021, and you went to buy those same goods today, it would cost you 1,200. So the prices in those 4 years, they rose very sharply in 22 and 23, less so in 24 and 25, but it still cost you €200 more to buy that basket of goods. And that's really, as Neil was talking earlier on about the silent thief, that's what inflation typically does for investors. It eats away at our savings, and that's why it's so important to try and protect the savings.
Yeah.
So that's inflation. I suppose the other thing people often say, well, we had the war in Ukraine, we had oil prices rising very significantly. It had an impact on the global economy. So what did the world equity market do? Well, this is a chart that just shows 22 all the way to the end of 2025. What you can see here is that certainly, yes, we had the Ukraine war. Equity markets did go down, and they continued going down somewhat in 2022. But what you can see is that over the following 3 to 4 years, global equity markets actually did quite well. And I suppose what you can see last year, as I mentioned, if you just click on to the next part of this slide, what you see is that that was the Russian invasion. Equity markets certainly traded down for a number of months, but perhaps Liberation Day tariffs had a greater impact than actually the invasion of Ukraine. So what we can see here is that, yes, the headlines were bad back in February 2022. People were very concerned about what would the invasion mean, the implications obviously for Ukraine, for Europe, and obviously the impact on the energy prices, which was quite severe at the time. But I suppose what this demonstrates is that equity markets generally do move on over time. They adjust to the information, and generally things get back. So, probably stay in the course and not taking knee-jerk reactions when some very bad headlines comes along is probably a more sensible course of action.
Yeah, I really do agree with that, with everything that we've seen over the years.
Yeah. And it's hard. It's very challenging, when you get markets and you see the headlines and you'll hear stories about the prices. If you switch on, home heating oil is going up by X hundred versus the previous month. It is quite challenging, to say, well, actually, this will work out. But generally, what happens to companies, and there's companies in the World Equity Index, is these companies adjust. They work out what has to be done. They'll rearrange their activities. They'll change their manufacturing. They'll change their prices. They'll change how they market. So generally, companies are very good in adapting their own business models to take advantage of the situation. And unfortunately, while we've got situations that are happening in the Middle East at the moment and the impact that it has on real people, generally what happens is that markets do move on. They adjust to the information, and that's typically what happens.
Okay.
So I suppose if we look back, and I'm just looking back here from virtually the month before the invasion of Ukraine, when equity markets were doing okay, and then they went down a little bit. But if you look at the 4 years to the end of 2025, and you were looking at inflation, Irish inflation, it turned out at just over 20%. So it was eating into your savings if you didn't do something to try and protect yourself from that. And if you left your money in a cash fund, so there's cash funds are a bit like deposits. If you left your money in a cash fund, so you'd get a return from that cash fund, but the cash fund return was only about 9%. So it didn't protect you fully against inflation. And then, as I showed you in the previous slide, if you went into pure equities, and I don't think that that's an appropriate mix either, but if you did go into pure equities, you'd have got a fairly good return of 33% over the 4 years. But perhaps, more likely, if you were looking at a recommendation back in 2022, you probably would have looked at maybe a multi-asset fund. And the multi-asset funds in the market, as the name suggests, consists of different types of assets. So multi-asset, you'll have some equities, there'll be global equities with some of the largest companies in the world. You'll have some bonds, which could be government bonds, could be corporate bonds. You could have some cash in there. You might have some exposure as well to property in there. So there's quite a few different multi-asset funds that are available to investors in the Irish market. And I've just shown a blend here that are on the New Ireland Fund Centre. And if you took a third and put it into the Goodbody Fund, a third into iFunds, and a third into Prime, so that's 3 of the multi-asset funds, the return there would be close to 18%. So it protects you quite a bit from inflation over the period. And I think that's something, that's very important.
Yeah.
So I think, that's a bit of a playbook, Claire, just looking back on, what happened in 2022, perhaps it gives us a little bit of a guide to ultimately what will happen over the next few years. Certainly there's a bit of volatility at the moment in terms of equity markets and what's happening because of the oil price. But ultimately, generally what happens to equities is they typically continue to actually go up. And the key thing is not to take a knee-jerk reaction in the middle of the headlines. And that's what we'd be saying.
Yeah, great.
So this is our outlook for 2026, and there's no doubt about it. I think, the first point there, all eyes are on the Strait of Hormuz. And really what investors today and over the weeks ahead are really looking at President Trump just to see, how does this end? What is the solution? How can some form of acceptable solution be created? And there's no doubt about it, that President Trump is urgently looking for, as they call it, an off-ramp. How can he de-escalate this? Because at the end of the day, with the pressure on the Strait of Hormuz, which is causing the oil prices to increase, which is potentially increasing inflation, that's not good for the re-election and the midterm elections that are coming up in November of this year. So all eyes are on the US midterm elections, and the Republicans are desperate to hold on to both houses again. So what they will desperately want to try to do is to get a resolution with regards to what's happening in the Middle East. However, I do think that could be challenging. There's a lot of moving parts in that area. But I suppose from an investment point of view, we would have said that, the fundamental backdrop globally had been quite supportive for equities in 2026, albeit what's happening in the Middle East has raised some of the risks. And on the next point, I suppose the key thing is that global growth, is going to probably come down during what's happening in the Middle East, but we're still likely to have positive global growth. And there's a couple of major things that are driving it. The first thing that's really driving it is the bill that President Trump brought in this year, which is called the One Big Beautiful Bill. Once again, I'm not sure who he gets to come up with the names for his legislation, but it's certainly different. But the One Big Beautiful Bill has got a number of factors in it. And one of the factors is tax rebates for individuals. And those tax rebates are starting to come through this month. So people will get more tax back than what they paid for last year. And they'll get that in the form of a check. And one thing that we know about Americans is that when they have money in their bank account, they generally go out and spend it. So the One Big Beautiful Bill is generally quite good for US consumers. The other area of that bill that's very, very important is that he's given a discount on any capital expenditure. So if you were investing as a company in a new site or a new piece of machinery or a new factory, the tax benefit that you'll get from that is going to be bigger in 2026. Now that benefit will fall away again in 2027. So there's a big incentive for companies to invest and do acquisitions in 2026. And the other part of the spending bit that really comes down is the German infrastructure. So for a long number of decades, Germany as a country was just not spending enough money, which seems very strange, but they just didn't like debt. They had a fear of debt going back all the way to the 1930s when inflation took off, and they generally didn't want to spend money. So if you looked at various countries across Europe and you looked at the level of debt compared to the size of their economy, the Germans have got very, very low debt levels. So they can afford to spend. And what they've committed to do last year was to spend on infrastructure and defense. And that's likely to drive growth across Europe. So that's where we see the growth coming from, is some of the fiscal side of the equation. And we're also expecting to see further growth coming from AI investment as well.
Very interesting, yeah.
Now, the other thing, though, that probably has changed a little bit in the last couple of weeks is what's likely to happen to interest rates. And that's been impacted by the threats of inflation and the threats of inflation that can come from the higher oil prices. So central banks have a mandate to try and protect us against higher inflation. And they use the lever of increasing interest rates to do that. So we had been expecting that US interest rates would get cut twice this year, But after the recent price increases in oil, inflation expectations have risen. So we're unlikely to see any US interest rate cuts this year. And the other thing that we had expected is that within European interest rates set by the ECB, those interest rates were expected to stay flat. If we look at what the market is pricing in today, we're expecting 2 increases in European interest rates this year. So maybe if you have, a
Yeah.
variable mortgage, it's maybe
People
something to
on the
consider.
call here who have like I just got options in for my variable mortgage, and I'm in my head thinking I need to fix possibly for a year at least because otherwise it's going to go up. That's the type of thing, James?
That's exactly it. I think some of the deals on the fixed rate mortgages are probably not going to be there for too long. So if you know of anybody that is coming off a fixed rate mortgage or is currently on a variable mortgage, it might be something to go and have a conversation, with an advisor to see what they're seeing at the moment in the marketplace. Because at the moment, the financial markets have gone in the last couple of weeks of saying no interest rate hikes to 2 interest rate hikes. So it might be a good time to do that.
Very good.
And then inflation, I think we've talked quite a bit about that. But the other thing, though, that does give us a bit of, confidence is the last point here. If we move on to the next point, is that if we look at corporate profits, they're still likely to be quite strong in 2026. What we're looking at is that corporate profits, which is the profits of all the companies in the world index, and you add them all up, how much do they increase year on year? So back in 2024, the world index, all the profits of the companies in that index grew by 7%. Last year, they went up to 9.7%. If we're looking at the forecast of what we expect this year, even despite what's happening in the Middle East, we're looking at earnings growth of 15%. So I think that 15% will come down somewhat, but we're starting at quite a strong position that if we get a resolution in the Middle East, we still got fairly strong corporate profit growth. And I think that can be supportive for equity markets, particularly in the second half of 2026.
Okay, very good.
So I suppose we're on to sort of the investment options that, and Neil can jump in here at any stage, but, some of the investment options that many investors might have. And I suppose the first one is cash and bank deposits, and everybody knows about them. And, I'm talking about the challenge, and we talked about, how inflation can eat away at it. The point, though, I will make is that I believe firmly that cash has a part to play in an overall portfolio, because
Great.
everybody should have some cash in a rainy day fund that you just might need. So when we talk about the threat of inflation, we're talking about in case somebody has all of their money in cash, that might
Yeah.
not be the best way forward over the next number of years. But certainly cash and bank deposits do have a part to play. And that's the bit I'll certainly be having the conversation with my mum later on in the week. I suppose the second bit that you might consider investing in is maybe something like government bonds. So you look at the Irish government, they issue bonds to fund a lot of activities, whether that's infrastructure spending or paying for social security. But the bonds are issued and the government agrees to pay investors back a certain percentage each year. So they could issue, for instance, a 5-year bond. So you issue the bond today at €100, and the government might say, we'll pay you 3.5% every year for 5 years. And that's what you get. So your risk there is if the Irish government has to default and doesn't pay you back, which we think is quite low in the current environment. The next one is corporate bonds. So a little bit like government bonds, it's you're lending money to a company. So if you think of maybe some of the big companies that are around Europe, you think of maybe some of the car manufacturers like BMW, they'll issue corporate bonds and investors will pay for them. So you typically get a better rate of return on corporate bonds because there's perhaps a slightly higher chance that the companies are a little bit more riskier than the government bond. So you might get a little bit better return there. But often what you'll find is you'll get a fund that has a mixture of government and corporate bonds, and that mitigates a lot of the risk, within the fixed income side. The next thing you might look at is property, and I suppose there's a great fondness for property in the Irish economy. Irish people love property, and I suppose there's two ways you could look and play property. The first one is directly go out and buy a property, and that can have positives and negatives. The positives are that you control that actual property, you can decide who you're renting it to. Slight negatives are you have to look after tenants, etc. You do have a single property, so you're increasing your risk slightly to a single property. Or the other way to play property might be to invest in a commercial property fund where you've got an array of different types of properties. So you might have some manufacturing properties in there, you could have distribution centres, you could have offices in there. So that's the way that many investors in Ireland play property today. Then the next one is commodities. And when we talk about commodities, generally we can break them down into a couple of different areas. We've got the energy type commodities. You could play your oil prices, gas prices. You've got then your metals, gold, silver. And then you've also got other commodities like softer commodities, as they're called, which is the agricultural commodities. So you could be playing things there like soya beans and wheat prices. And given what's happening in inflation and fertilizer prices, they've been going quite well in the last little while. So commodities is another part of a solution that many investors might want to consider. Equities, I think most people probably on the call tonight know about equity stocks and shares. Some of the biggest names that we would have in the world are the Magnificent Seven companies that we often talk about, the Nvidias, the Microsofts, the Googles. And then I suppose closer to home, the equities often gets quoted on the radios are the bank stocks here in Ireland and Ryanair. So these are stocks and shares. They trade every day. They go up and down depending on the news flow, whether they've had good profits out, but also on sentiment as well. What do investors think? Are they more bullish on a company for the next couple of years or less bullish? So sentiment plays a part there. And then finally, and this is perhaps one more so for the younger people, and they typically look at crypto and they talk about these different crypto coins. And I'll put my hand up and say I know very little about it. And often those conversations, I can add absolutely nothing. It's certainly higher risk, typically crypto type investments, if investments are the right word, are certainly a lot more volatile than many of the other investments. And I suppose they're the sorts of arrays of investments. And, really what an advisor will try and do is pull some of them together. And it depends on your risk profile. And if we just move this slide on to the next part, what you'll see in this list here is that the lower risk ones are towards the top of the slide, and the higher risk are certainly towards the lower part of the slide. But generally, what we're trying to do is balance it out, because typically with lower risk, you get a lower return. With a higher risk, you typically get a higher return. And that's really what advisors are trying to do, is to put together a combination of this to actually get a better return than the complete value of the risk that you're actually taking. So, the way we often look at it on the next slide, if we move it on, is it's a bit like a jigsaw. Yeah. So what we're trying to do is put together various funds that can diversify your exposure to different types of those previous assets. So you're thinking of your equities and cash and property and government bonds. And if you change your allocation to those different asset classes, it'll change your risk. But I think the key thing is that everybody's attitude to risk will be different. So that's why it's so important, to have that conversation with Neil to find out what is your attitude to risk. Because the last thing I think anybody on this call wants tonight is that somebody invests perhaps in a fund and goes to bed worrying about it. If you're going
Absolutely.
to bed worrying about it, it's not a good thing. You don't want that to be happening. Yeah. So it's really to do with your attitude to risk. So next steps, what would you do? First thing, talk to IPF and talk to them about you. That's the most important thing, because it has to be tailored about you. We then need to find out what is your appetite to risk and what's your required returns, because everybody might have this idea. As Claire says, maybe you're thinking of retiring, you've got that cash lump sum, you want to go away on 2 holidays a year, or maybe you only want 1 holiday a year. So your return that you require could differ. So if your returns are less, maybe you don't need to take as much risk. So, you can balance it out that way. So that's very important. The next thing that you need to do, the next bullet point, is trying to reduce your risk by understanding what you're invested in. Don't be afraid to ask Neil, what is this fund doing? What am I invested in here? And don't be afraid to say, actually, I don't understand that. Tell me again, what is this fund doing for me and what can I expect from it? Because I think once you understand what you're invested in, you're more likely to stay invested in. For instance, if you're invested in a fund and it's got some really good quality companies in it, and yes, the share prices can move around, but if you know they're really good quality companies, those companies are going to be there in 3 years and 5 years and 7 years. They're still going to be, expanding. They're still going to be driving new products. And that allows you to sleep easy at night. So don't be afraid to ask the questions and understand your investment and what you have your money in. And then finally, what we would say is have your financial plan, and certainly IPF can provide that to you. And the most important thing to do is to stick to it. That's not to say your financial plan will stay fixed forever, because your circumstances can change.
For sure.
But financial plans are really useful, particularly in times like the last 5 or 6 weeks, because you've got your plan. Generally stick to it is generally the best advice, because we just don't know what can happen. The volatility can change. At the moment, everything looks a little bit challenging. It's probably a kind word, but President Trump, he certainly puts out different tweets and can change things very, very quickly. And he could come out with a statement at any stage saying he's won the war, he's changing, and oil prices could fall very quickly. And you know what? Equity markets could move ahead very quickly as well. And the risk you would have is that if you're not invested and you miss that, that could be a challenge. And this is something, because if you stick to your plan, you're staying invested. And this was something one of the largest fund managers in the world. And on the next slide is he's actually from BlackRock. And the CEO of this business said, his name is Larry Fink. He was saying this yesterday. He says, typically, he was warning against trying to time equity markets. He says, but if you miss some of the best days, it could have your returns. So he says it's far better staying invested than trying to time the market. And the details he was given yesterday, he was saying that for every €1 invested in the US market over the last 20 years, every €1 increased 8-fold. It went up 8 times. But if you missed the 10 best days of the market, so you just didn't happen to be in the market, you were sitting in cash, you only went up 4-fold. So that's the difference.
Okay.
So staying invested typically works out best for investors in the long run.
Very good. That's so good. Thank you so much. So James, I'm going to keep you there because I'll have some questions for you in a minute. But Neil, we're just going to loop back to you.
Yeah.
So
look,
people on the call tonight.
Yeah, so they're going to be asking themselves lots of questions after all that information to take on board and think about themselves. And I suppose what we want them to ask themselves, really following on from tonight's presentation, is a couple of questions, right? Look, if you are looking to invest in, how much do you have available to invest? And I think James made a very good point that we would always say, look, you need to have that nest egg there in case of a rainy day. And typically speaking, we're talking 3 to 6 months of net income to have available, that if something was to come up, that you have it available to you. But the next point, and it's really, really important, is what time frame are you thinking about investing for? So I've often been asked, look, I have 20,000 there to invest or whatever it might be. Happy to stick it away for 2 years. Unfortunately, that's not the kind of time frame you want to be looking at. Because like that slide that we looked at previously, you could have had Donald Trump could have got up on the wrong side of the bed and decided to put more tariffs on the world in that 2-year period. Yeah. And the markets won't have had time to basically adjust, like James said, reassess what the current situation is. So we would always say, and I think James, you'll agree, a typical average investment period is 5 to 7 years. And it allows you to go through that investment journey that I think you touched on really well, James, that these things will happen. And I oftentimes hear people say, well, what if this happens? It will happen, but the companies in the markets have to adjust to it. And they're not going to, just because of tariff, decide to close up the windows and close up the shop. They're going to continue on as a business, but they need time to reevaluate. And that's what you have to allow the market to do in the background. So that's why you have your rainy day money, but you have your investment money that you're willing and you're happy to leave invested and don't feel you need to pull it from the market anything shorter than 5 years. And I suppose the next question is, what is the objective? So I suppose an objective of saving for retirement is a long-term objective. So it could allow you a little bit more risk. So you could actually invest in maybe a higher equity-based fund. Whereas if you're maybe in a 5-year period where you want to make sure your money's keeping in line with inflation, you know, you have a retirement lump sum that you might want to go on that big holiday in 5 years, you mightn't be as willing to, be as heavily invested in equities. And that's what we'll try and hone in with you. And then an income. Do I need to get an income from this? And this is something I've gotten asked questions on more recently
People
than
think
ever.
it's gone, it's locked away.
Yeah, it's gone. And,
Yeah.
whereas I had one client speaking to me, a couple of clients actually, they've disinvested in property, for example, because of these changes in regulations, but they like the idea of a regular income. So they say, look, I'm going to have this cash lump sum. I'm really disappointed. I know I'm going to invest it because if I leave it on deposit, it's not going to work. But I miss that regular income. Whereas in fact, you can have that paying your regular income. So, that's again, ask the financial advisor, and there's solutions and options that you can identify. And when it comes to Irish Pensions and Finance, we'll look across the board. We're not a tied agent. We'll look at the different providers, the different nuances of the different options, and be able to pinpoint one that's suitable for you. Access. Will you need access? And if you do, is it really realistic to put an access feature on it? And if it is, we'll be able to show you what you can do with it. But again, it draws back to making sure you have an amount set aside in the event of a rainy day. So they're kind of some of the key questions that to ask yourself ahead of sitting down with a financial advisor or taking that 5-minute screening call, really. And then some other considerations, right, and really important is, look, when it comes to doing an investment, look, what is the allocation rate and what's the fund management charge? So when we're talking about allocation, it's how much of the investment is invested. And then the fund management charge is essentially the running cost for the investment. So, the fund manager in the background, making sure that the fund is doing what it's supposed to be doing. But just be conscious that an investment is like anything, it's on economies of scale. So the more you're investing, potentially the more advantageous the allocation or the fund management might be. So make sure you just ask those questions and understand it fully. But your advisor, when they sit down, will be very much explaining that to you. Now, when it comes to the charging structure or the fund management charge, there can be an additional charge for more specialized funds. They're typically managed funds, and they typically will have a purpose behind that additional fund management. Some funds, for example, will have a put option, which in effect, it's like a bit of downside protection that helps in choppy waters, if you will. And, it has its place as part of typically a blended portfolio. So you might have a portion of your fund with that bit of protection in it. Additional contributions. So, for example, at midpoint in the investment journey, another bond, a lot of times we'll have people that have had money in the post office that matures. Can I add it into that? It may make sense to do so, but maybe not if you're looking at maturing that investment for a reason after 5 years. So again, questions to ask, things to go through with your advisor. Encashment options. If you do have to go in and take a portion of it out or all of it out, what is the implications on you? And again, we go through that in detail with you when you're setting up your plan. The next one is a really, really important one. I think what happens to the pot if I was to pass away. And I suppose if you're doing the investment, that's why it's important as a couple, if you're doing it as a couple, to do it together. Because the investment then can carry on in the other person's life, as opposed to if it's us in your life and you were to pass away, it's automatically disinvested. And if you're at that point of an investment journey where maybe the fund is in a flux, you may not want it to be disinvested and be, adversely affected. So if you do have an existing investment and it's in your own name, maybe it's worthwhile to speak to an advisor about that. But if the main thing is that it does go to your estate. So that's an important thing to understand, So
and the advisor can talk, so say for instance, the people on the call here, don't have a spouse or somebody, we'll explain to them, like if you leave the money to this person, the implications from, an inheritance tax point of view and all that.
Exactly. Inheritance tax point of view is really important for you to understand and how to structure it. So that you know all the outcomes of the different possibilities associated with it, very much so, yeah. Then taxation. So I suppose unavoidable, like everything in life, tax, unfortunately. oftentimes we sit down as financial advisors and they think we have a magic wand, we can wave and remove all tax, but unfortunately that doesn't exist. There is tax on the investment, but it's a tax on the gain that you make on the investment. Okay. So what it would be is a rate of 38%, and it's applied on the eighth anniversary of the policy, or if you're to disinvest after a period of time. Now, the benefit with that being the way it is that it's handled by the insurance company. So it's not something that you necessarily have to worry about or get up in a sweat in the nighttime thinking, I didn't make a tax return for my investments. That's all handled in the background. Okay. So again, I think the solutions that's provided by speaking to a financial advisor, availing of the plans and investment plans like James spoke about previously, is a lot of all the things are handled in the background. Really, what you come to us with was what you want to achieve, what your objectives are, what you want to see happen, and we provide a solution. And after that, you have peace of mind knowing, look, have a good plan. I'm going to stick to it. If I'm concerned, I can call Neil or I can call one of the advisors in IPF. And that's really, really the most important thing. And I think when we sit down with a client and when they walk away saying, I'm really happy I did this now, that's
Yeah.
probably the best thing as a financial advisor. You're kind of sitting there thinking, okay, I've done a good job here and they're happy, everyone's happy. So
Right.
so I think talking to the financial advisor and taking advantage of this part, which is the screening call, is so, so
Yeah.
important. Again, going over old ground a little bit, but what we'll do is we'll go through the fact finding process, identify your short-term goals. So like we say, see how much you need to have in that rainy day cash fund based on your circumstances. Identify what your objective are. Is it maybe 5 years to get a bit of home renovation done? Is it children's education costs 5 years, 10-year term? Understand then what level of risk is suitable, make the recommendations based on an open market option. So we'll look at all the providers in the market, take account maybe if you have investments already. We want to complement that portfolio that you have and be sure that the recommendation, is covering all bases. And then go through the application with you. And as of course, which is included in your fund management charge and things is your regular reviews, which is really important to know. At the end of the line, you have a financial planner you can speak to. And, I have had that call. I remember getting the phone call at COVID time. I think it was my own father was around, the market was falling down at the time and he had a pension from when he was working. He was saying, this keep going down. And I just said, look, you just have to stick with it
Yeah.
and stick with the plan. And, I was hanging up the phone, even though
Absolutely.
I was a bit like, whoa, but yeah, but it was the right advice and it was the right thing to do because I
Stick
think
with the
James
plan.
said, if you move out of the market, by the time the market's decided to recover, you'll have missed out and you'll have locked in that. So just,
Yeah.
always speak to a financial advisor before you make any of those kind of decisions. It's really, really important.
Great. Okay, so I think we've got time for some questions. Okay, so as I said, people who registered for the call this evening were invited to put some questions. We've had an awful lot of questions, so I'm going to put a couple to James and then Neil, and then what we'll do is, as I said, we'll be in touch with people after this evening, and we can deal with their own individual questions if we don't get to handle them.
Yeah.
So, James, I'm going to come to you first. So we had Louise in the civil service. She was just asking. What recommendations are there regarding ethical investing?
That's a great question. So there's a number of funds in the market that do ethical investing. And I suppose maybe by answering it, there's sort of two parts to this whole area. The first part is ESG, and the second part is ethical. And if you could just bear with me for 1 second, ESG investing has become very popular over the last number of years. And ESG stands for environmental, social, and governance. So what ESG is talking about, and it puts a framework around certain funds and says that what they're trying to do is the right thing from an environmental point of view, from a social point of view, how they treat their employees, how they treat customers, but also from a governance point of view. How is the company run? Does it have appropriate structures in place? Does it have controls in place? So ESG as a thematic has risen in prominence over the last 5 or 6 years, but it often gets a little bit perhaps confused with ethical investing. And ethical investing is slightly different because ethical investing is to do with ethics and what are your ethics. So often in ethical investment, you'll see certain people will want to screen out or not invest in certain parts of the market because of areas that they don't feel comfortable with. So, for instance, companies that might be involved in things like stem cell research, they don't want to get involved in that sort of area at all because of what it's doing with regards how cells are redeveloped, etc. They don't feel that's the right thing to do. The challenge really with ethical investing is that everybody's ethics are slightly different. So you've got different funds and they'll approach it from so many different ways. And that's the real challenge. So when you are looking at an ethical fund, you really need to read down through the literature to find out what ethics are they actually promoting, because they can be quite different. ESG is slightly different because generally the way it is run by legislation and it's been run out of Europe. So generally ESG supportive funds are called Article 8 funds. So if you see Article 8 beside a fund, generally that fund manager is trying to do the right thing on the environmental, on the social, and on the governance side. So that's the slight difference. But there is some ethical funds out there. But what I would suggest is read the literature very carefully.
And I think one thing I would have seen over the years as well is just to obviously look at the type of risk profile of some of those funds.
Absolutely, Claire.
Just
They can
because they're
differ
ethical doesn't mean
dramatically.
they're going to be low risk.
Correct.
Great. And James, while I have you there, Ashley in the HSE, she was just asking, like, what options are there for low risk investing, or is there any?
I suppose in the low risk investing, you're really depending on your attitude to risk. Can you afford any loss at all? If not, well, then you're probably looking more at deposits or maybe some of the government saving schemes, etc. And that's really very, very low risk. I think, what you can do though is that you could perhaps start off by taking a little bit of risk, if you're talking to your financial advisor and put a certain, even a small portion of money into something that's slightly more risk and just follow that investment over a period of months and years, and you can see what sort of risk that happens generally to that investment. But the low risk ones, really what you'd be looking at would be more sort of bank deposit rates and maybe some of the state savings. And I was looking a little bit at some of the state savings and the 10-year bonds and different things like that, and the returns on them, in my opinion, are probably quite low at the moment. I was looking at something and it was close to 2% each year. Well, if inflation is running at 3% and the challenge of inflation perhaps going up over the next number of years, well, getting 2%, you're still going to be losing some of your purchasing value. So it's going to eat into you. So I think it's probably well worth having a conversation about what your attitude to risk. But I do always come back as well to the point earlier on, if you're if you're investing in something and you're really worried about it, talk to the financial advisor, because often what the financial advisor can do, if you're worried about it, they can often lower your risk as well. So you're not particularly locked into one investment all the way through. Advisors like Neil can actually come along and say to you, well, actually, do you know what, within the portfolio we can adjust it slightly and maybe move you down the risk profile. So
we can oftentimes taper it off as let's say, maybe as their life changes and their circumstances have changed. We can typically taper it off into the lower risk space. That's oftentimes something we see people wanting to look at.
Now I'm just conscious of time, so before we get to our question, we hope everybody's been listening. Neil, there was a good few questions in about Mairead, actually, from the HSE, was asking about options with our children's allowance, because that's money that's coming in every month. And what have you seen, and what do you suggest?
Like, it's a question we get asked all the time, like, what should I do with it? And I oftentimes ask, what are you doing with it at the moment? And then, 9 times out of 10, you might find that they're popping it into the credit union. And, when we sit down and we talk to them and say, well, look, how old? And we look at the timeline until they may need it for third level education, we find, like James said, that may not be the best or most suitable place for it. And there's multi-asset saving funds where you can take advantage of, I suppose, the market. Like, you're not going to have to do all the heavy lifting for that education cost over time, and you can use a bit of return along with your savings, because I know inflation will impact on our shopping, our cost of fuel, but it's also going to impact on the cost of education of your children, because I think Zurich and a few different companies have looked at research, and I think it was about 25,000 euros to put one child through college, and that's provided they stay at home.
So yeah,
You know,
if
which
they're going out, they're leaving home, it's even
yeah,
more.
which not everybody's a big fan of. Sometimes they might be more inclined to see them wave them off. But that in 18 years' time, if 3%, if inflation runs at 3%, is going to be more in the round of about 45,000. So
Right.
if you're saving into something that's not getting you maybe 1% or 2%, inflation is not going to keep in line with that. So that's why I'd say, look, talk to your advisor. If you have someone very close to going to college, that might be credit union is probably the best place to leave it. But if you have that bit of time where you can save
Yeah,
regularly, it's not going to be all on you basically trying to build that money up.
that's great. Well, look, as I said, I'm conscious of time. So, Sarah, you're back.
I am indeed. Always my favorite part of the webinar, Claire.
Yeah. So,
So hopefully everybody has been listening out. I think James dropped a couple of hints to the question coming up. So I've opened up the chat there. So if you all want to pop in, and as Claire said, it'll be fastest finger first. But the question we have is, by what percent have oil prices increased since December 2025? So this was in one of James's slides that he had there earlier. So we have a couple of answers in already. Very fast fingers this morning.
yeah.
So, okay, great. Good few answers, a good few 86, 20, 50, 100. So the answer today was 86%. And so I think the first person in was Kate Doherty. So well done, Kate. We'll get
Well
your one
done.
for all voucher out to you, Kate. Well done.
Great. So look, that was brilliant. So look, thanks very much, James, for joining us this evening. Sarah, thanks very much for putting all of the slides and the
Yeah.
introduction together. And Neil, thank you very much. Thanks for everybody for joining.
Thanks,
And
Claire.
we will be in touch, obviously, if you want to scan the QR code to get, on the list first. But otherwise, we'll be in touch with everybody after this evening. So thanks a million. And Sarah, you're going to email out the slides and the
I
recording.
will, and the recordings. Will everyone
Yeah.
have that tomorrow? Yeah, great.
Great, great.
Super.
Thanks, everybody.
Bye.
Have a
Thanks,
nice
everyone.
evening. Bye.
Take care.